about how much we're going to pay in taxes. So it's an exclusive free webinar where we're going to give you some tips. And whether you are a physician here or you are a healthcare worker, or even if you're not, it applies to all of you on the platform. You're all welcome. Hey, I see Brenda. You're welcome, Brenda. Brenda, you're welcome. Valentine, you're welcome. Aaron, you're welcome. Welcome to everyone. Welcome, welcome, welcome. And thank you for taking the time. I know we're all busy. But again, I always tell people that when it comes to talking about your estate, you always want to make time to make it happen. Yeah. So I want to welcome all you all to this platform. Again, like I said, we're going to talk a lot about people in the healthcare business, but these strategies apply even if you are not in the healthcare business. And if you're out there, you're struggling with structure, you're struggling. I mean, the whole game is around structure. If you structure properly, the top 1% who pay zero in taxes is all because they structure properly and they work with the right people. If you want to play the game in this country, you want to play with a strategist. You want to play with someone who is looking after you from a strategic standpoint. That is what the top 1% do. They have something called a family office. A family office is an office like mine, which works exclusively for people. So individuals, they have a strategist office, which is working exclusively for them all year round. And that's what we provide here. We also provide strategy to those who are on our platform so that you can be in the game of the top 1%. That's exactly what we provide here. So if you're out there and you're paying any crazy amounts in taxes, every time you pay taxes, you ask yourself, if I'm paying these taxes and all the top 1% are paying zero in taxes, it means I am overpaying in taxes. It means I'm doing something. I need to do something else to be able to avoid paying all those taxes. So I'm excited to have all of you here who are taking the time to basically come and listen to these, because some of these things are life-changing. They are basically life-changing. If you can structure your estate, I mean, you will notice that over the years, every time you're paying your wealth away. Income is not wealth. Income is just money. We talk about ordinary income. Ordinary income is what? Miss, hey, Rich, maybe you want to mute everybody. Just mute everybody, please. Perfect. Thank you, guys. Yeah, thank you so much. So basically, it's 4:02 and we're going to start. Let's start the whole, and I'm happy you guys are here. And thank you for making the time. Today our topic is how to save 50 plus in taxes. We're talking mainly to physicians, but we're talking also to contractors. We're talking to real estate professionals. We're talking to anybody who is paying over $50,000 in taxes. Anybody who's paying over $10,000 in taxes. I mean, if you're paying taxes, whenever you pay taxes, you should be asking yourself, is there something out there that I could have done not to pay these taxes? Because that's the only, if the top 1%, the top 3% are not paying anything in taxes, it means that every time we pay in taxes and we are not, we are overpaying, because there's something out there that these guys are doing not to pay taxes. There's something out there that these guys are doing to protect their assets. There's something that these guys are doing to be able to basically build wealth using other people's money. And who are the other people? Is the middle class, the people who are being screwed. So we want to learn that and understand that we cannot be considered the middle class. We want to be the top 1% as well. And how do we get there? We have to do those strategies. The biggest part of our wages, of our income, of our wealth is what we give to the IRS. So today I'm just going to start by looking at some slides here. We're going to share my screen. And just let me know if you're getting me. If you're not, I'm also watching messages that are coming through. So if there's anything that you think about, or if there's something that you want to talk about, just note it down. We'll have time to talk about them. Today is so I'm excited to have you guys again. We're talking about how to save 50 plus taxes, 50 plus 50K plus in taxes. And this is for physicians. It could be for contractors, real estate professionals, and what have you. So basically, our goal today is to teach the top strategies. I mean, I would call it the top strategies. We're just talking about the strategies that are out there that you guys can use basically to avoid paying taxes. We're focusing on taxes, but we could be talking about structure. Structure is everything. When you think about your estate, you're thinking about structure. When you think about savings, you're thinking about structure. The top 1% of Americans who pay zero in taxes all have three things in common. Number one, they protect their assets. Asset protection is number one thing that you want to do as well as an individual. When we talk about estate planning, it's around asset protection. So once you're doing asset protection, that's number one. You want to think about how do you structure those assets? How are you going to put those investments, those real estate that you have, or maybe you're dealing in stocks or whatever you're dealing in as a passive activity. You want to see how you structure it. Your active activity, you will also want to think about how do I structure these things. So today, our goal, the first thing, our goal is to make sure we understand this. So I talk about number one is asset protection. Number two is tax mitigation. Tax mitigation. When we talk about these guys who don't pay taxes, they are doing something. They are mitigating taxes. Tax avoidance, you are allowed to avoid taxes. You're not allowed to evade taxes. If you have to pay some taxes, you will have to pay those taxes. But there are ways to preempt, to plan, to avoid all of these taxes. Another thing, the last one is to build wealth. All these top 1%, when they mitigate their taxes, when they structure their estate, that's how they build wealth. And we can do the same. So the aim today, we're going to talk about this in a way that you can take this and do it yourself. Most of us in our communities, we just go and give our taxes, and then the CPA tells us that, oh, you're going to pay $50,000 in taxes. You're going to pay $100,000 in taxes. And most of us who are on W-2, we are just happy to say that we didn't pay any taxes at the end of the year. But think about it. Every month you're paying, maybe if you're earning, say $5,000, $10,000, you only take home about $6,000. $4,000 is gone every month. So at the end of the year, when you're happy not to pay nothing, almost 1/3 of your income is already gone to the IRS. And that's if you are in a state like Texas, where we don't have a state tax. If you're in a state where they pay state tax and you're a higher income earner, you pay more than 50% of your income is going to the IRS. So you have to have a strategy for it. Yeah. So today, my goal is to teach top strategies that have saved hundreds of thousands of dollars to some of my top clients. And I want to show you how you can do it yourself. And this works even if you are already working with a CPA or a bookkeeper. I want you to start implementing these strategies today. So you have to start doing it for yourself today. Who is this for? It is for you guys, the physician. It is for the contractor. It's for anybody who is seated here who is paying a lot in taxes. Anybody. I mean, my focus is usually on people who pay over $50,000 in taxes because I think you're throwing your wealth away. You're basically throwing your wealth away. And one thing I want to say here is that most people think that it's by paying taxes that they are better citizens. They are better corporate citizens. Nada. When you pay taxes, it's because Donald Trump puts it well. He says it's because he is smart. And this has nothing to do with politics. This is what every person that you know in the top 1%, they do the same thing. They don't pay any taxes. Why? Because there are things out there that they can do to pay taxes. And why don't they pay taxes? They don't pay taxes because the tax code is structured that way. The tax code doesn't say that if you make too much money, you don't pay taxes. But when you accumulate assets, you don't pay taxes. When you accumulate assets, you don't pay taxes. And what is wealth? Wealth is not income. Wealth is assets. It's your net assets that determine your wealth. You're only wealthy if you have assets. You could make $10 million a month or a year and still be broke if you don't accumulate assets. But if you make those $10 million and you're not keeping assets, you're not taking care of your tomorrow, the IRS believes that you're going to depend on Social Security and they're going to tax it heavily, heavily. So it is for those who are high-earning people who are tired of overpaying in taxes. If you're frustrated with having to give strategies to your own CPA about, oh, I have heard this, I've heard that, then maybe you've outgrown your CPA and you want to look for a strategist because you want to build wealth, and that is the way to go. We want to help you build and save your money. We want to help to build wealth so you can save. For those who cannot, you want to build wealth, yet you cannot save. That's what it's saying. You want to build wealth, yet you cannot save. Think about this. We are in a capitalist economy. In capitalist economy, it's a small company. It is small. It's very small economy. It means that the government doesn't manage anything. The government is very small, and then the masses take care of the game. We are the ones running the game. The top 1% have taken the game and have held it captive. So all of us in the middle class, we're working for them. The game, what we're doing here is to remove us from that rat race, remove us from that place and get us into the top 1%. And I see this all the time without any iota of a doubt. If we all implement some of the things, just some of the things we're talking about every Friday, every Tuesday on this program, on my platform, if we implement them, we are going to be in the top 1%, like before we even realize it, without having to do any extra thing, because we're already working so hard. Remember, it's not about income. It's about how you plan and you structure that income. So you're tired of overpaying taxes, this program is for you. What makes this difference? Okay, think about it. So basically, we believe that it is your right not to pay taxes. Think about it. It is your right not to pay, not to overpay, not to pay taxes. And how do you get into that position where it is your right? By doing those things that the IRS has in the tax code. The American dream is in the tax code. And we only don't get into the American dream because we don't learn how these things work and we don't work with the right people. I mean, maybe some of us believe that doing this is too expensive for us. So we work with the wrong people and we are completely throwing our wealth away. Every time somebody pays $500,000, $50,000 in taxes a year, you just gave away $500,000 worth of real estate that you've amassed. And that will help you save even more taxes in the future. That is the game. And that is the way the tax code is structured. We believe that it is your right not to pay taxes. If the top 1% is not paying taxes, you too can do the same. And that is the game. We know that about 99% of CPA are not strategists. They don't understand. I mean, I'm a CPA, but the thing is, CPAs are trained to prepare and help you pay taxes. A strategist's job is to help you avoid taxes. So when you work with a strategist, his job is to help you avoid taxes using the normal tax strategy, the tax code. The tax code has all these things for you to avoid paying taxes. So we're singing this. The top 1% has been doing this. We too can do the same thing. So basically, one thing, I'm sorry. So my name is Charles Njoya. I'm a CPA. I'm a mainstream certified tax strategist. I'm a wealth coach, and I run this company called CHN Advisors. We are a tax and estate strategy firm. We are located here in the Woodland, Texas, the Woodlands near Houston, Texas. Again, These are some of the factors that cause us to overpay in taxes. Number one, improper entity structure. Structure is always the most important thing. Think about it as if you're doing anything, if you don't structure it, you're going to get killed. Structure is important for asset protection. Structure is important for tax mitigation, and structure is important for your wealth building. That is the key. The second thing is missed retirement strategies. Most of us work in companies where we have 401ks, we have 403bs, we have all these sort of things that are out there. And in the best case, we contribute to them, but we don't even understand how those things work. We're not taking full advantage of them because we don't understand them. Missed retirement strategy, and some people, they don't even contribute at all. So if you're not contributing, I mean, you're not taking advantage of nothing. But if it's there, we can even make it work better because the strategies, the top 1%, I mean, you're always thinking, you always want to have, this is my goal. This is this is my ultimate. This is where I want to be. If you don't have a goal, if you don't have an apple that you're looking at, you will never get to where you want to go. Missed retirement strategies, missed deductions. I mean, I can tell you so many things. Missed deductions is one of those areas where most people don't take advantage of the tax code. Another one is, and then missed investment is real estate. This is a very big one. Real estate investment is one of those games where everybody in America plays. The top 1%, they might have their money from doing IT or from being medical, owning medical practices or whatever they own, or from creating some crazy stuff. Whatever you own, the way you preserve it, you transfer it, it is through real estate. And in America, one of the things that you get to basically leverage the tax code is real estate. That's why we focus on real estate. In our program, every person in our program buys one real estate every year. You will buy one real estate a year. And how do you buy it? It's not by doing any extraordinary thing. It's just by playing the game that we ask you to play. You play that game, you buy real estate. The more real estate you buy, the less taxes you're going to pay. The almost zero you're going to pay. And that real estate, you're leveraging other people's money. So you save in taxes, and then you get wealth. You keep building wealth. So when we talk about all these things, I'm just going to go straight to something. Our goal here, before I get to the strategy, so we want to help you, help we want to help you avoid overpaying in taxes. We want to help you structure your estate. We want to make sure that you have the trust that you kind of need. You have a proper revocable living trust. You're structuring all your LLCs. You're structuring all your entities that you have. You have what we call the trifecta. You have the right side of your trifecta working for you, and then you are actively working to create more value into the right side of the trifecta. Those are the type of things we talk about. So here, we'll talk today about those strategies. And some of these strategies might appear to be so straightforward to you. It's because they are straightforward. It's because they are straightforward. It is not rocket science, some of these things. And the reason I'm bringing them here is because I want you to do it yourself, DIY. Do it yourself. And even if you cannot do it, know that those strategies are out there. My game, I keep telling this all the time. My objective is that those of us who are in our different communities, who are working so crazy, we need to know how this country works. Because when we understand how this country works, we understand how to use the tax code, we are going to find ourselves in the top 1% in very short time, doing the same things that we're doing. So number one strategy, bookkeeping. Bookkeeping is one of the things I do. I do a lot of tax resolution with the IRS. And one of the biggest problems that people have when they have to pay, when they are paying some crazy stuff with the IRS, especially small business owners, is bookkeeping. Bookkeeping is the most important thing when it comes to taxes, when it comes to growing your wealth. If you don't keep books properly, you're not going to go anywhere. This is, I mean, There is no bigger strategy, like I said, than bookkeeping. The only way you win with the IRS is through record keeping. The only way you build a successful business is by keeping statistics. Your bank statement will never cut it. Most people think that, okay, I have my bank statement. It doesn't cut it. And even if you think that those bank statements actually cut it, I mean, I don't want to go there because that's a very long one. Most of us have one credit card that we're just commingling. We're commingling we're buying our food with it, we're buying cars with it, we're doing business with it. And then every time we're commingling. So you don't want to commingle, you want to keep separate books and records for your business. This is what gives value to your business. This is what is going to give value. Even when you want to sell, you have to have a system. You have accounting, you have bookkeeping, is going to save you a lot in taxes. When people don't have records, they are even afraid to take deductions. And that is where what we see all the time. You tend to pay to the IRS because you cannot support not paying to the IRS. So number one is bookkeeping. Number two, and this is very important, for those of you out there who have businesses, who have moved away from you're no longer working on a W-2 and you're now working for yourself. And if you are on a W-2, you're out there, you have a W-2, I always tell people, always get a side gig, no matter how small, because that's where the game is played. You want to get a side gig, no matter how small. And I'm happy we're having this discussion in February. It's still the beginning of the year. And if you're struggling to set up something, talk to us, contact our company. We'll have our attorneys work with you. We'll have our team work with you. We'll help you structure it in the best way possible. So for those of you out there who have maybe a side gig, or you have your business and you're netting over $40,000, $50,000 a year net from that business, number one, you want to elect an S Corp. The reason you need to elect an S Corp is because when you elect an S Corp, you have an LLC. The LLC starts making money. It's netting over $40,000, $50,000. You want to move straight to an S Corp. When you move to an S Corp, and I'll show you some examples here. I have some basic example that I just want to show you. So an S Corp is a form of an LLC election that provides tax benefits. It provides you asset protection as well. So let's look at these two examples here. We have two scenarios, and I'm telling you why. In one scenario A, the company is both the company is netting $150,000 in both cases. Both of them are netting $150,000 in income. In scenario A, which is on the left side of the screen, you have it is filing a return. You don't have two separate tax returns. They are filing the return on your personal income tax return. So your business return is inside. What does that mean? That means that you've not elected that S Corp status that I just talked about. So this guy in scenario A does not elect the X Corp election. What he does, the federal income tax on that is money, just federal. I'm not talking about state. We've not included any state here. We're just talking about federal. And if we had to include state, it would be an additional amount. So the federal income tax for this guy here on that $150,000 is $31,000. Remember that our tax system is progressive. So the more you earn higher, the more you're getting into those higher tax brackets. And those higher tax brackets tend to take more. But here, this guy is paying for federal income tax, is paying $31,800. So almost $32,000. And then there's something called self-employment tax that applies first to that 150. On that self-employment tax, is paying another $24,480. So basically, his total tax on this money is $56,340. That is his total tax. Now, if this person elected an S Corp for his business, so he gets a salary. So now we get something that you call salary dividend split. You're splitting the salary between dividends. So we do what we call a compensation study. That compensation study basically studies how much you can pay yourself as an employee of that corporation that you just created. So in this case, you're paying yourself a salary of 50, and then $100,000 is going to as what? Is going to as dividend. What happens is that your federal income tax is still the same like what you had in scenario A, 31,824. But remember, the self-employment tax in scenario A was 24,480. In this case, you're only applying it to the 50,000 that you're paying yourself. Because self-employment tax only applies to you working as an employee. You're working for yourself. So that part of that income that was given as dividend, the $100,000, avoids that 15.3% tax. So basically, instead of paying another 24,480, now you're only paying 7,600. You just saved yourself as a result of that one single transaction. You saved yourself 16,830 just by doing that one single move. So this is so important that you know when to convert your asset, when to move asset to an S corp. The second thing, the main benefit is to help you save money on self-employment taxes. That's what we said already. So the potential is great. It's crazy. We see people who save up to $25,000 just by doing that one single movement. And this is because there's a cap on what you call Social Security, which is self-employment. Are we together? I hope we're together. I hope we're together. So basically, we're going to number 3. We've talked about number 1 was bookkeeping. Number 2 was election of S corp. Number 3 is accountable plans. What is an accountable plan? When you own a small business, you are not eligible to write off home office. Remember, we just moved from our LLC. We just made it to become now a business. It's an S corp. You are not eligible to write off home office. But home office is usually a very big deal because home office, not only does it allow you to share some of the home costs with the IRS, it also allows you to take the depreciation of that part of your home, which could be a huge amount of write-off. So basically, we can't let that go because in most cases, what I see is that when somebody gets to this level, they know because the IRS doesn't allow you to be able to write that. Most CPAs just say, no, we cannot write out. But you can. You can. These expenses are allowable to self-employed. So you can. There is no such expense on the company's tax return. So if you look at your tax return, the business tax return, you will not see home office there. So you have to get creative, else the IRS is going to reject those expenses. This is a contract. When you talk about an accountable plan, it's a contract between you and the S corporation, allowing you to write off certain expenses that are clearly identified and specified. So we think it's a policy document. It's a contract between you and your business. You can ask your business to reimburse you for the expenses you make on behalf of the business as part of company policy. So the tax code allows you to write off ordinary and necessary expenses that are reasonable in the pursuit of income. The plan must define what is eligible expenses and also what is necessary. What are those costs that you have to write off? Some of the things that you can write off here: travel, home office, meals, supplies. Think about it. Things like utilities. Write off your cell phone. There's so many things you can put there and write them off. Here we're seeing write-offs between $30,000 to $50,000 in normal scenarios. That's the average. So it tells you that there's a big write-off you can do there depending on the size of your business. That was number 3. Number 1, number 2, number 3. Now let's go to number 4. So number 4 is something that most of you have heard about it, but it is a little bit complex to implement. And you have to meet certain criteria to be able to take this. But this is where the big boys play. This is why we basically encourage you to buy real estate. You buy real estate because you have tangible assets. It's not going to disappear. It's there. You have the turnkey. It's right there for you. But most importantly, also, you are leveraging other people's money. When you buy real estate, You want to buy that $1 million property, they tell you bring 10%. You're putting your investment in that $1 million property is basically $100,000. So basically, but even though you only invested $100,000, the IRS allows you to include on your asset side $1 million worth of that asset. You own that asset. Even though you have debt on that asset of about $900,000, you can take the whole asset and then leverage it and wipe off your entire your income with it. This is so important. This is where the big boys play. They accumulate assets using other people's money. The code allows them to use the assets, even though they took them on credit. You're using all the other people's money, the $900,000 in this case of that property that we bought, that $900,000 that you consider, that's not my money. It is other people's money. It's the money of the middle class, of those people who are caught in the rat race. They put in the bank and then the smart people take it. Then you write off income. You can take that from the asset side and come and write off your ordinary income with it. And that's where the big boys play. So you can eliminate your taxes with that. You can cost segregate this asset. Cost segregating means you're just breaking the asset into smaller pieces, and then you can now take them based on their depreciation. Let me ask you let me tell you, the roof, the cabinets that you have in your home do not depreciate for 39 years if it's a commercial property. They don't depreciate for 27 and a half years if it's a residential property. Because that is the rule. If you don't do cost segregation, you're going to depreciate them. You're going to write off that asset over 39 years or 27 and a half years if it's a residential property. So now the IRS allows you to be able, if you meet certain requirements, and this is a big if. This is a very big if. That is one of the reasons you want to work with a strategist, because he makes you qualify for that. You have to qualify. And if you qualify, this one single game is what they call this one single play. One single play can make you write off to $150,000 in taxes. I say that because we do that for our clients. If that one single play can write off 100,000 and above in taxes, just that one play. So it's a big thing, big thing. Okay. Another one is investing in real estate. Investing in more real estate. Well, if real estate is giving you, I tell people about real estate. Think about this. Think about McDonald's, for example. McDonald's, that's the biggest chain of donuts in the world. They make their money from donuts. But that income is ordinary income to them. They are not wealthy because of that money. So now they have to convert it into assets to create wealth for them. So what is the wealth of McDonald's is not in the donuts, it's in the real estate. That's where the value is. Because whenever you see a McDonald's place, they're usually at very strategic and central location. They own that real estate. They're buying the donuts and converting it into real estate. That is where the power is. So you want to do the same. Investing in real estate. So you're accumulating assets with the tax savings. Remember, I just told you that in our program, you buy one real estate every year. This is the game. You're saving and leveraging. You're leveraging other people's money. You're leveraging other people's money. Some people buy 3, 4, 5 real estate a year. Some people buy what we call, you buy apartment buildings. You can buy, we can talk about this all day long. And these are things that we can all do. We need to start thinking different. Our mindset shift will completely shift our story. It will change the story not only for us, it will change it for our next generation, for our kids, and for everybody around us. We're talking about things that have everything to do with your well-being, with your tomorrow, with your legacy. Number 6 is what some people call the master's rule. Some people call Augusta rule. What is this? This is a very big game. This is a very big thing. Most people don't know it. When you own a business, you basically can just write a check from that business, equivalent to 14 days of staying in your whole property. I'm not saying staying in a part of your property. So basically, the IRS has this rule, Code Section 28A to 288, that allows you to be able to earn income from renting your home. So renting out your home, you can rent your home out to a third party. You can rent your home out to a third party as long as it is 14 days or less. You don't have to show the income. Think about it. So you think about it as strategies, you're like, So if I can rent my home, let's say my daily, I think about it, about where I live and things like that. Let's say my daily rent on my property is $1,000. And some people might think, oh, why is it $1,000? I mean, think about it. You want to look at comparatives with properties around your location. Remember that your rents, the rents have nothing to do with your mortgage. Nothing. It's about your home. How does this, if this was a hotel, what would it go for? So you look for comparatives and make that. So you make that determination. And then as long as you can rent it for 14 days or less to a third party. It means you can rent it to your business. You can rent your home to your business for your business to come and sit there and do and have a meeting. You're not renting a home office, you're renting the whole home. So for 14 days, you rent it. And then what do? Basically, the concept is that at the end of the day, maybe you have a meeting there with your family because you just have your family members of your board of directors and or board of advisory. They're all there. You sit there for 14 days. You just go out there. The IRS is basically telling you, don't change nothing in your lifestyle. Just write a check as long as you meet certain requirements. Again, there's always a caveat that you may want to talk to us on a one-on-one so that we tell you what those caveats are. So basically, you think you just sit there, you write a check for $14,000 from your business into your pocket. That income that is now included, that now comes to you. That $14,000 is deductible to your business, but it's not taxable to you. Guess what? You just took $14,000 out of your business, and then you're not going to taxes. It's like free money. That's the rule. That is what this rule is all about. So that's a big strategy out there. So basically, the thing, this rule exists for owners to take rent. Okay, basically the key here is to keep records. Check average daily rent in your area and then write it off. You're writing it off. You're basically deducting it. Number seven, are we together? Do I have a crowd here? I want to feel, I mean, if you're together, just send me, I want to see somebody sending something in the send some. I need to see that people are listening to me. I'm not talking to myself. Send a message on the chat. I want to see you say yes on the chat. Say yes on the chat if you're out there. And if this is making sense to you, I want to see a yes to the chat. Otherwise, I'm almost like I'm speaking to myself. Are you there? Yes on the chat. Yes. I see you coming. Yes on the chat. So yes, I feel that, okay, we're together. So this one here, and listen to me very carefully. This is a game changer. I've talked about so many game changers, but this one is a game changer. And the reason I call this one a game changer is because it will create that thing that we have all been longing for. The history, when you think about certain communities, about communities of people like me, we're always thinking, we have not had access to our children. We've not inherited anything from our parents. We didn't do nothing. There was no legacy left for us. So we have to create our own every time we have to struggle. No way. These things have always been there. The IRS code tells you explicitly that one of the benefits of owning a business is hiring your own family members, hiring your own kids. On the face of it, it looks like nothing. You should make your kids work for you. It looks like nothing. It looks so plain. It looks so straightforward. They should provide actual work. What I mean here is the game that you're playing here is, what is the game? Basically, what it means is that you can allow 90% of us, 99% of us who have businesses Our children are constantly working for us. You are basically, oh, get me this thing. Oh, go and do this for me. Go and do that. Oh, call the child and tell him, okay, can you do that for me? The child is constantly doing something for you. But the problem is that we never document the work that these children do. And what does that mean? It means that at the end of the day, we are not able to substantiate that this child has worked, and then we need to make we need to pay that child. My process is that, when I say that, my process is that when you need to document the child's work, give him actual work. The child will be doing basic things. The IRS has withheld that at the age of 7 and above, I mean, the courts have withheld that at the age of 7 and above, you can basically make your child work for you. Or if that child, or if you are the custodian of that child, I'm talking about your child or the child who is under your custody, under your legal custody. Because if you hire someone else, it is illegal. It is only legal if it's your child or your legal child who's under your legal custody. So you can make them work for you at any age. There's no age limit. So a child could be 2 years old and is already modeling for the parents who are doing fashion, who are in a fashion business. So if that child, you can document and show that this child is doing some modeling for all these dresses that we're selling for this, then you can write off that child. You can include payroll for that child and pay that child. Pay that child a reasonable wage. And that's important. Why is that important? That's important because the standard deduction here in America is $13,000 as of last year, $12,950. It's gone off to, I mean, somewhere around $13,500 in 2024. What does that mean? That means that you can pay a child up to $13,000 and that child doesn't have to file any tax return. Remember. And you can pay a child up to $13,000 and that child doesn't have to file a tax return. So basically, if you have 3 children, you're paying them $13,000 times 3, that's $39,000. That $39,000 is a deduction in your taxable income for you as the parent who is in the higher income tax bracket. And now that $39,000 is the money that you're going to use to do the same things that you were going to spend on those kids anyway. You pay for their tuition, you pay for their this, pay for their that, you're moving money from their own bank accounts and paying that. That is not, and then that money is not taxable to them. So you just saved yourself maybe $10,000 or how many, depending on your tax bracket. You just saved yourself just by pushing down that income. But that child has to do actual work. You cannot say the child worked, whereas you cannot document. You have to document and show so that you can prove that the child worked. That is the big thing. Now, you have already written off a lot in taxes. You've saved in taxes for yourself, and then you've allowed the government to be helping you take care of the children. Doing those same things, your holiday, whatsoever, they're paying out of their bank account. But what is more interesting here is what you can do with that money you just saved for them. So imagine yourself saving that, and then you go one step in the strategy. You're telling yourself that, okay, I just saved these children, I just paid them $7,000 or $10,000 or $13,000 this year. However, the IRS allows you now that because that child actually worked, you can now take that child's income up to $6,500 a year. You can put that in a Roth IRA for that child. Okay, that's where it becomes really crazy. So if you took $6,500 for a child who is 10 and put it in a Roth IRA, that child only accesses that money when he is 59 and a half. So that child will access that money in 49 years' time. Crazy, 49 years' time. That's when they access that money. So you just put $6,500 for one child for 1 year. And then if you discount it, you remember, this is compound interest. That money is being compound interest 49 and a half years, $6,500, 49 and a half years, compound interest. If you think about it, that child is making over $1 million, about $1 million, just by that one time. So if you did it so many times, let's say it was, even if the child just made $700,000, because you're think about it from the S&P 500 rate over the last 30 years. Look from your computer, just type on your computer. I think the rate's about 9-10%. So if you use that 10% for over the last 30 years, S&P 500, and then you compound that 6,500, if you did that for 1, 2, 3 years, 3, 4 years, or even 1, 2, 3 years, you just created your child at least $3 million, $4 million when the child retires. That is what you call real gain. That's where the game changer is. That child is starting from scratch. As in you've already taken care of that child's retirement. That is where we change our story. And if you are a smarty, if you're working with a strategist like us, you can take that money as the child is growing and self-directed. That money, if you self-directed that money and invested in real estate, it can multiply itself by 10 by the time that child gets to there. I mean, that 3 million can multiply itself by 10 by the time that child gets there. So that is the game. This is the game changer. And for all of you out there who have kids, you have businesses, you want to think about making your children work for you. But this is a thing that you want to do. Make sure you're structuring correctly. You want to speak with the strategist so that it can help you structure it correctly. And then you are playing the game. This is the game changer. This is why we talk about asset protection, tax mitigation. We just mitigated taxes and we're building wealth. That is the game. So having said that, number 8, equipment deduction. We can do a lot here. So let's just take a summary of what we just talked about today. Bookkeeping, electing an escort, setting up an accountable plan, cost segregation, leveraging retirement accounts, investing in real estate, master's rule, hiring your kids, and equipment deduction. Isn't this crazy? If this is not value, if you think that we just gave you value, say yes in the chat. Please just say yes in the chat. Yes in the chat. I want to see yes in the chat. Yes in the chat. And if we didn't give value, say no in the chat. You're free to say no, because this is what we're doing. This is educating our community so that we can change our story. Most people I talk to, they believe that it is a scam to say that you are going to make people not pay taxes. That's because our mindsets have been focused, have been put in that manner. And we just think that we're just thinking like the way the top 1% want us to think in that way that we become their slaves. We live in a rat race and they are living on the beaches. So we want to change our mindset. This is the game. Our game is about changing our mindsets. That's what we're here to talk about every Friday. And then we have meetings as well on Tuesdays. You'll see some meetings coming through. So we need you to implement these strategies. We need you to start thinking about how the wealthy think. We need you to start thinking about working with people who understand strategy and not just working about taxes. These things have been kept for people who are millionaires and billionaires and whatever up there, but we're bringing it mainstream. We want all of us to take advantage of these things. Again, there's a price attached to this. But if you want, it all depends on you. The game is, if you want to change your game, you want to change your story, there's a price attached to it. It's to do all these things, it takes a lot of investment. I'm not saying that it costs it doesn't, it takes a lot of investment for those of us who are playing this game. So if you want to contact us so that we can set this up for you, we are available. Everything you want to do, implement the strategies to maximize your tax saving. Review this training again to ensure you're getting the best out of these strategies. Schedule a time to sit down with myself or someone within my team to walk you through your tax challenge. And if you're here, let me show you what to do next. Schedule to sit down with me, with either myself or someone in the team. Generally, you sit down with me, and I'm going to tell you what your own situation is, what you can do for yourself to get into that game where you already know where you're going. Again, you go into our website. It's CHN Advisors, www.chnadvisors.com, and you book a free discovery call with me, and we'll talk about your situation. Again, and if you want to follow us, please, those are our contacts. You can go to our website and book a free discovery call. You can go to Facebook, follow us on Facebook, on Instagram, type my name. There's a lot of value that we're giving out there for free. Look at them on the websites. Look at them on our pages. Go to Facebook, go to Instagram, go to our YouTube page, because we have all these materials there for you to take care. Is that making sense? I want to see some stars. I want to see people telling me, is this making sense? Did we just have value here? Did we share value? Did we share value here? I need you to put, if we shared value, say yes in the chat. I want to see yes in the chat. So you're now open. I just gave you can contact us. You can book an appointment anytime. Go to our website. I see you, Sophia. I see you, Chotu. I see you, Sylvie. I see you, Aaron. I see all of you. Thank you so much for making the time today. And please book a time and let's talk about these things, because this is the game. This is what's going to change your whole game. Thank you. Thank you for taking the time today to sit with me. I appreciate you all. And if you have any questions, I have 2 minutes to answer a question. I don't know if there's any question in the chat. Let me see. Do we have any questions in the chat? No. Great job. Great job. Thank you, guys. I appreciate you. I think either I was very limpid, either I was very clear, or if you have any questions and you maybe you don't want to talk about your personal situation here, you can just go ahead and then share this so that people can learn as well, so that other people can learn. We want our community to wake up. We want our community to get to the next level. And it all goes by learning, getting those things that were privy. We don't learn these things in any school. We learn them through programs. We learn them by investing ourselves in these things. And that's why we're throwing it out there. I want to thank you so much. I want to appreciate you. You have an excellent weekend, and I'll see you very soon. Thank you so much. Bye-bye.
Address. But for now, it is shown as say, I get to go for belts, I get to feed it in them, and then I get to submit documentation. And then I get to start my mentorship hours. If they buy a woman between us, unfortunately, if it is,